Good morning, everyone. We will be discussing about risk and rates of returns. For the overview of our presentation, I will be the one to discuss about what is risk, type of risk preference, what is return, what types of risk and return. And for Ms. Charmaine Ann Castillo, she will be discuss about what is portfolio return, standalone risk, standard deviation, source of risk. And lastly, for Ms. Shane Fernandez, she will be discussing about capital asset pricing model, security market line, and beta. Risk and rates of returns. Looking around us, we will find that different financial activities like investing, depositing, or savings in banks, or even starting a business give different returns. But why? To answer, we must first understand the idea of risk. Have you ever have you ever tried na tumaya sa loto? Or hindi naman kaya, have you ever tried na maglaro ng scratch card? Kung hindi, because of the law of interest or law of probability of winnings. Are you a risk taker? If yes, because of you have skills or attitude that a risk taker, or you have a lot of possibility na marami kang chances na maging instant millionaire in one day or in an hour. Today, we will tackle about what is risk. Risk is defined in Webster as a hazard, a peril, exposure to loss or injury. Risk is the chance of financial loss. Risk is used interchangeably with uncertainty to refer to the variability of returns associated with the of a given asset. Sabi dito, when there's a risk, there's an uncertainty. This is the chance na yung mga desired output natin will not be happen. So sabi nga natin, pag di tayo nag-take risk, di natin makukuha ang mga reward na gusto natin. Sabi nga ni Benjamin Franklin, in this world, nothing can be said to be certain except death and taxes. And how much risk are we willing to take? So depende po yan sa mga references natin. Okay, some people could be race averse. So dito, sa race averse, tatalakayin natin mamaya sa risk preferences natin. For today, we discuss about types of risk. We have systematic risk and unsystematic risk. For systematic risk, risk that impacts the entire market or a large sector of the market cannot be diversified or not controlled. So sinasabi dito, ito yung mga risk na maraming limitation or dito sa system na to, umiikot dito yung mga limitation ng types na to. Kasama na dito si currency risk. Si currency risk, ito yung mga chance na maapektuhan ng business operation or value ng mga investment because of change of rate. Natakel naman na ito sa mga nauna pang grupo. So we have a knowledge what is risk or what is currency risk. For equity risk, the chance na bumaba o tumaas ang market value ng mga shares of stocks. Inflation rate risk. The possibility that the value of our assets or income will be lower because of the inflation. Hinihila kasi nito pababa yung mga purchasing power of a certain currency. Pag sinabi nating purchasing power, ito yung mga um, ito yung mga pag pag pagbaba ay pagtaas bigla ng mga presyo ng mga bilihin. Halimbawa, dati kung ang mga candies natin na nabibili tulad ng mga Mentos, ganyan, nabibili natin siya ng 3-5 piso. Pero ngayon, nabibili na lang natin siya ng 250 isa. So parang ang lumalabas, sa 5 piso mo, dalawa na lang. Na dating 3, dalawa na lang ngayon. So ganun din sa mga business natin. May inflation risk silang nararanasan. For interest rate risk, that is the possibility na yung value ng mga security, particularly yung mga bonds. Itong bonds natalakay na to sa last reporter. So alam na natin kung ano yung mga sakop ng mga bonds. Ito kasi yung magiging mas mababa because of increase of the interest rate. Pansin natin dito sa systematic risk. We notice that the generally beyond our control, itong systematic risk na to. That's why tinatawag tong non-controllable. And for unsystematic risk, specific to individual asset can be mitigated through diversification. For unsystematic risk, it is a risk that affects a company or only one industry. That includes in principal risk. Principal risk, ito yung mga chance na mawala na yung entire investment natin because of the possibility of bankruptcy or magkaroon ng default. So alam naman na natin kung anong ibig sabihin ng bankruptcy and default kasi natakil na to sa last reporter. For credit risk, this is the chance na yung mga bond issuer, for example, they delay the payment of principal as well as the interest. So si bond issuer, imbis na maging on time sila, nagkakaroon sila ng credit risk kasi yung mga bonds na nakukuha nila, nagkakaroon din ng aberya. So dito sa bond issuer, alam na rin natin kung sino-sino sila kasi discussed by Group 5, natakil na rin to. So, liquidity risk, this is arises from the difficulty in selling an asset. Ito naman yung nililiquidate na nila yung mga investment nila. So, yung mga investment nila na pwede nilang i-convert to cash, sinesell na nila, mapababa o mapataas man yung kanilang kita or magkaroon man sila ng loss kesa mas bumaba. So, pumapasok din dito yung pagiging inflation risk nila. Sa call risk naman, in case of callable bonds, merong risk sa cash flow natin. So, yung mga cash flow natin, maaapektuhan siya. Ba't siya maaapektuhan? Kasi magkakaroon sa cash flow natin, meron tayong mga profitability, liquidity, solvency, and yung reputation as well natin. So, sa solvency, nandito kasi yung mga financial obligations natin na dahil sa nagkakaroon na ng mga risk sa ating business, hindi natin, may nararanasan tayong mga financial obligation na hindi na natin nagiging nasasakop. So, parang kung may utang man tayo sa isang bank, hindi na natin siya na babayaran. Kasi pataas ng pataas na yung mga interest na nakukuha natin. Dahil nga sa pagbaba din ng mga investment and other businesses natin. Risk preferences. What is risk preferences? It is refers to an individual's or organization's willingness and inclination to take on risk in pursuit of financial gain. So dito makikita natin na yung gap, yung return pataas, then yung risk pakanan. So, lumalabas dito na parang the higher the risk, the higher the return. So, dito sa ating risk preference, meron tayong 3 types. Risk averse, risk indifference or neutral, risk seeking. So, sa risk aversion natin, for risk averse, It is the investor prepares investment with lower level of risk and willing to accept lower returns in exchange for more predictable outcomes. Ito yung mga attitude ng isang investor na mas gusto nilang mag-risk kesa parang mali yun, love. Ito yung mga mas prefer ng investors na mababa yung risk, mababa rin yung return. So, ang characteristics nila dito, nagpo-focus sila sa wealth ng preservation, tsaka preference for low risk investment, emphasis on capital protection. So dito, nagkakaroon sila ng lower potential for significant losses and limited growth potential. Kasi nga, nagbe-base lang sila doon sa kung magkano yung ni-risk nila, yun lang din yung expected return na matatanggap nila. For risk neutral or indifference, it is the attitude toward risk in which no change in return would be required for an increment risk. Ito naman yung mga investor na mapa-higher or low risk yan, hindi sila nababahala. Parang wala silang pakialam. They primarily focuses on the expected return of an investment regardless of the associated risk. Ito yung mga may characteristic na equally consider high risk and low risk investment. Kasi hindi naman lahat ng nire-risk nila is high return din yung mga tanggap nila. So, hindi na sila nag-e-expect na high risk, high return sila. So, sa kanila, neutral lang. Sakto lang yung mga mindset nila. Nagpo-focus sila kung paano ma-maximize naman yung mga expected returns. So, dito, pumapasok dito yung pagiging unsystematic risk nila. Lalo na dun sa liquidity na risk na meron sila. Kasi, dinadiversified nila yung mga assets nila para hindi lang na may bumagsak na isang business nila, lahat affected na. So, dito, makaklassified sila as unsystematic risk. Then, dito, may advantages sila na potential for moderate growth talaga. Kasi, dito, understanding nila sa mga businesses nila as investors. Alam nila kung kikita ba talaga yung business na papasukin nila or investment na papasukin nila or hindi. As long as may return silang makukuha, okay na yun. So, then, ito, limited impact of market fluctuations. Kasi nga, na-diversified na nila yung mga businesses nila or assets nila. So, malaki yung impact na hindi naman ganun kalaki yung pagpa-fluctuate ng mga businesses nila. For risk-seeking naman, risk-seeking investors are willing to take on higher levels of risk in pursuit of potentially greater returns. They are more comfortable with the possibility of significant losses in exchange for higher potential gains. Ito naman yung may mga characteristics na they focus on wealth accumulation, preference for high-risk investment, emphasis on capital growth. Then dito, ito naman yung mga attitude nila ng investor na which decrease return would be accepted for an increase in return. So dito lumalabas yung high risk, high reward nila. So the most common example dito is yung gamble. Kasi syempre, marami kang nire-risk na asset mo. Then yung magiging return mo din is high kung sa probability natin magiging maganda yung kakalabasan. This is the advantage of higher potential for significant gains and greater likelihood of substantial losses. Sila kasi yung mga risk-seeking, yun talagang hindi nila iniisip kung magkano na yung na-risk nila at kung magkano na yung return sa kanila. Sa risk preferences category naman, nandito yung mga definition and characteristic. Kay risk averse, prepare lower risk investment for more predictable outcomes. Then sa investment strategies nila, nandun yung mga bonds, fixed income security, blue chip stocks, diversified portfolios, lower potential for losses, limited growth. Yun yung advantage and disadvantages naman nila. Then, nagpo-focus din sila sa wealth preservation and capital protection. For risk neutral or risk indifference, equally consider high risk and low risk investment. Focus on maximizing expected returns. Sa expected returns, mamaya may computation na i-discuss si Miss Castillo para mas maintindihan natin kung paano siya nakukuha. For investment strategies naman ni risk neutral or indifference, balanced portfolios, index funds, ETFs, target date funds. Sa target date funds kasi, ito yung parang sa bonds na pinoprovide sa atin. Meron kasi dun mga due dates na kailangang masettle natin. In 5 years, kailangan may returns na ganyan or wala or maglulos ba siya. So, advantage and disadvantage nito is potential for moderate growth, limited market impact. For risk-seeking, definition and characteristic niya is willing to take higher risk for potential greater returns. Kasi nga sila nga yung walang pakialam kung magkano na or super lost na ba sila. Focus on wealth accumulation, capital growth. Investment strategies, growth stocks, small capital stocks, high yield bonds, alternative investments. So dito, lumalabas dito na ang dami nilang stock kasi nga ito yung super diversify sila sa mga nire-risk nila. And advantage and disadvantage for risk-seeking is higher potential for gains, greater likelihood or losses. So now, what is return? Return is the total gain or loss experienced on an investment or a given period of time, measured as cash distribution during the period plus the change in value, expressed as a percentage of the beginning of period investment value. So for single asset, ang formula ni return, rate of return is equal to amount received minus amount invested over amount invested. So for example is meron kang total investment na 1 million. Then kay stock A mo naman is nakatanggap ka ng for 1.5 million, nagkaroon ka ng 500,000 na return. So 500,000 minus 1.5 million over 1.5 million, ang rate of return natin is negative 0.67. So, magiging loss natin siya. Bakit? Kasi 1.5 yung ininvest natin, pero yung return na nakuha natin or na-receive natin is 500,000 lang. Expected rate of return, I will be calling Miss Charmaine Castillo for discuss. Thank you.
There are two types of risk and return, the portfolio risk and standalone risk. Portfolio risk is held as one of many assets in the portfolio. Standalone risk is all our money is tied to single asset. To understand more about portfolio return is a hands-off or passive investment of securities made with an expectation of earning a return. This expected return is directly correlated with the investment expected rates. It is typically expressed as a percentage and is calculated by considering the weighted average return of each asset in the portfolio. And in standalone risk, most assets are held in portfolios, but it is necessary to understand a loan basis in order to understand risk in portfolio context. the risk an investor would face if he or she held only one asset. Standalone risk is the risk that associated with single operating unit of a company, a company division or asset as opposed to a larger, well-diversified portfolio. Example, if a financial manager is considering investing in a single stock, they must consider the standalone risk associated with that stock. If the stock is in volatile industry with a history of market fluctuations, the standalone risk is high. It is the risk that exists solely or alone within the scope of that particular investment or project. Probability distribution. Probability distribution is a listing of all possible outcomes or events with probability assigned to each outcome. Probability is defined as the chance that the event will occur. It can also assign to the possible outcomes. So, we have the expected rate of return, or simple for RHAT. The rate of return expected to be realized from an investment. The weighted average of the probability distribution of possible outcome. So, we have example here of the probability distribution of Martin products and US Water. So, you can see the demand of the company's product, probability of the demand occurring, and then the Martin products, the percentage, and the US Water. So, in this table, 8-2 is the calculation of expected rates of return using the payoff matrix. So, if we multiply each possible outcome by its probability of occurrence and then sum this product, we obtain a weighted average of outcomes. The weights are the probabilities, and the weighted average is the expected rate of returns. So, in the example is the probability demand occurring and the rate of return the demand occurs. So, example of this, the strong normal weight. This strong has a probability demand occurring, the 0.3, and the rate of return of this demand is 100%. So, we're just going to multiply that and we're going to get the 30%. In the normal, we have a 4.4, then multiplied by 15, which is equal to 6. So that's the example of Martin products, and if the same if we're going to get the US Water probability. So we have a formula for the to get the standard deviation. But before we get that, we're going to compute the expected rate of return first, the deviation, and the variance. So to get the expected rate of the example, I already explained on how to get the expected rate of returns. So we're going to move forward to deviation. To get the deviation, we're going to subtract the possible outcome to the expected rate of return. So after getting the variance, we're just going to get the square root of the certain of the answer, and that's the standard deviation of the US product and Martins. So, standard deviation as a measure of risks. Standard deviation measures total or standalone risk. The larger measures, the lower the probability that actual returns will be closer to expected returns. Larger measures is associated with the wider probability distribution of returns. So we're going forward to coefficient of variation. Coefficient of variation is standard measures of dispersion about the expected value that shows the risk per unit of return. So to get the coefficient of variation, we're just going to divide the standard deviation over the expected return. So the source of risk is equal standalone risk equals to market risk plus the diversible risk. Diversible risk is which can be diversified away and is thus of a little concern to diversified investor. Portion of a security standalone risk that can be eliminated through proper diversification. Second, the market risk, which is reflect the risk of a general stock market decline and which cannot be eliminated by diversification, hence does concern investors. Portion of a security's standalone risk that cannot be eliminated through diversification, measured by beta.
Capital Asset Pricing Model, or CAPM. Widely used model for calculating the expected return on an investment taking into account its risk level. M is an investment theory that shows the relationship between the expected return of an investment and market risk. Components of CAPM: risk-free rate, the theoretical rate of return on an investment with zero risk. Market risk premium, the additional return investors expect for taking on the systematic risk of the market. And lastly, beta, a measure of an asset's systematic risk relative to the market. An example of CAPM: current yield on an US 10-year Treasury is 2.5%. The average excess historical annual return for US stock is 7.5%. The beta of the stock is 1.25, meaning its average return is 1.25 times as volatile as the S&P 500 over the last 2 years. Let's break down the answer using the formula from above in the article. So expected return equals risk-free rate plus beta times market return premium. Substitute the formula with its designated value. Expected return is equals to 2.5% plus 1.25 times 7.5. Expected return is 11.9%. Next is the security market line. It provides a framework for assessing the risk-return trade-off of assets and help investors determine whether they are adequately compensated for the level of risk they undertake. It is a fundamental concept in asset pricing theory and portfolio management. So SML is a graphical representation of the capital asset pricing method or model. The assumption for CAPM also hold for SML. The larger the level of systematic risk, the larger the expected return for the security is more risk equals more reward. In other words, it can be said that the concept is a method to assess the risk and return level of an investment graphically in order to decide whether the investment is worth or feasible. For example, the security let the risk-free rate be 5%, the expected market return is 14%. Two securities on one with a beta coefficient of 0.5 and the other with a beta coefficient of 1.5 concerning the market index. So substitute the value 5 plus 0.5 open parenthesis 14 minus 5 close parenthesis. For beta coefficient 0.5, the answer is 9.5%. Next beta is 5 plus 1.5 open parenthesis 14 minus 5 close parenthesis. 5 plus 1.5 times 9 is equals to 18.5%. That's the value for our SML to be plotted on the graph. Next is investors towards risk. Risk aversion assumes investors dislike risk and require higher rates of return to encourage them to hold riskier securities. For risk aversion, a risk-averse investor prefers low-risk investments that offer a guaranteed or risk-free returns. They prefer this lower risk even if it's mean lower return compared to potentially higher returns that carry a higher degree of risk. Next is risk premium, the difference between the return on a risky asset and a riskless asset, which serves as compensation for investors to hold riskier securities. For risk premium, it is the extra amount that you're expected to get for taking on risk. It is the percentage return you get over what you'd receive if you made an investment with zero risk. Lastly, beta, it measures the volatility of an asset's returns in relation to the market as a whole. A beta of 1 indicates that the asset's return moves perfectly in line with the market returns. A beta greater than 1 implies that the asset is more volatile than the market, while a beta less than 1 indicates lower volatility compared to the market.